Hi, welcome. Today I want us to unpack what we are calling risk-based credit pricing model in Kenya. As you are aware, these new rules will change your loan cost. So what is this that I need to know? It means that banks will no longer offer one-size-fits-all loans rates. Your risk profile will now determine how you will pay for your loan. But what does that really mean to you or to your business or to your next loan application? That is what I want us to unpack today so that we can be able to relate with and even understand when we talk about risk-based pricing model. I know it's the elephant currently, but we are going to unpack it and see how we are going to work around the matter of risk-based pricing rules that have been implemented. What is happening? I think one of the things I've mentioned is that risk-based pricing model is here with us, and it has been adopted by the Central Bank of Kenya. So under this system, we are saying every loan rate will now be linked to what we are calling KESONIA. KESONIA is what we call the Kenya Shilling Overnight Interbank Average, plus a premium, right, that will depend on the borrower's profile. So in short, if you are a low-risk borrower, you will enjoy lower interest rates. But if you have a credit history where you've not been paying your previous liabilities well, and the bank perceives that you are a risky customer, then it will mean you will need to pay more. So that is what is happening currently in the credit market. Then why does it matter? Of course, it's important for you to know as a borrower. It's good to know why it matters to you and to me as well. This move is meant to make fairer and more transparent the lending process. So before, the banks have been charging, a standard rate. So they've been saying that this is the base rate provided by CBK, and then for us, this is the much that we want to charge as a bank. But now, without regarding the risk status or the risk aspect of the client. But now this move will be able to help the low-risk customer obtain loans at a cheaper rate. Now, your credit behavior, your repayment history, your income stability, and the collateral quality will directly affect how much interest you will pay. So if this is implemented, and it is implemented in a fair way, then many businesses or many individuals may benefit. Though since the law has just been adopted, it may take time, but it's a plus. There are people who have a good credit history with the CRB or with the Credit Reference Bureau, and they will always ask, after all, if I have a good rating with the Credit Reference Bureau, how do I stand to benefit? So this is what now, or how you're going to benefit with now the new risk-based credit pricing model that is being adopted by many lending institutions. So it's good that you get to note that. And then for consumers and small businesses, this will mean that for good credit, you are likely to get the loan at a lower interest. And if you have a poor credit, a higher cost of borrowing or even loan rejection is likely to be imposed on you. So when I look at a credit report, let me give a good example of a credit report. We normally have a scoring range between 300 and 900. So meaning, if you are closer to 300, you are a poor borrower. If you are closer to 900, you are a good borrower. So borrowers with who are close to 900, that is the standard rating, therefore they will benefit by getting loans at a cheaper rate. And if you are near 300, you are considered as a risk customer, definitely you will get a loan that will be more expensive as compared to the person who has a good credit rating, right? Then real life, maybe, for example, we are saying borrower A, for example, if I give a good example of borrower A who has a clean income, has a clean repayment record, and has a good collateral. So what will happen? They will get maybe, for example, a better rate. Assuming a borrower B who has no regular income and has no good history, or he has a history of late payment, what is going to happen? Under the new model, the borrower A would maybe get a rate of 14%, and maybe borrower B is likely to face a higher rate of maybe even 18% based on the risk premium that the bank is going to charge on that borrower. So what should I do, or what is the way forward for me and you as a borrower? What is this that we need to know? One of the things is that, one, check your credit record. It is always good to know your CRB status all the time, so that you know how can you make your CRB status looking good. If you have been listed, you have loans that you have not been paying, I would advise is that you start cleaning up your record with the Credit Reference Bureau. What else do I need to know? You also need to start paying your loans on time. If you've borrowed, pay your loans on good time, because late payment also affects your score. Yeah, so if you look at your credit report, for example, it clearly indicates if you pay on time or you pay late. So if you're also paying your loans late, then you're likely to impose a higher interest rate under the risk-based pricing model. The other thing that you need to do is keep good financial records. So bank wants consistency. They want to see how your business is doing. They want to see whether you've been banking, how you've been paying, how you have been servicing your other facilities, be it an overdraft, be it a credit card, or be it even your mobile loan. So keep your records right. If you are running a business, you want to prove your sales, make sure you have your financial statements well outlined and well kept, so that they are able also to analyze your records and be able to ascertain whether you are able to pay the loan or not. The other thing, maybe an advice from this end, is that you also reduce unnecessary debt. Yeah, so debts signals a lower risk to lenders. You have so many debts that you are not paying, that you are maybe struggling to service. So that is also a red indicator that things may not be working well. Then we are also looking, therefore, what is this that I need to do? So you as a business owner, make sure your financial statements are clear and maintain strong relationship with your bankers, right? The other thing that you need to look at the big picture. What is the big picture? So this reform could make banks more selective. They might prefer clients with solid financial discipline. So if you have financial indiscipline, you are likely to suffer. Your business is also likely to suffer. The other thing, we can also say, all is not lost and all is not bad. We encourage, it will be encouraging borrowers to adopt a culture of responsible borrowing by helping them reduce bad loans and ensure that they ensure that we have a sustainable credit market. You know, when an economy has many borrowers who are not servicing their loans on time, or the debt levels are high, so what does that mean? It affects the financial market and negatively bringing in instability in the banking institution. So we can say that that is a plus to both the borrowers. It is also a plus even to the economy at large. Then as we conclude, we can say, therefore, the next time you're going to apply for your loan, remember the bank is not just looking at your income, it is also evaluating your risk history. What has been your story before they lend to you? So the better your story, the lower your cost of credit. So this is the new reality under the Kenyan risk-based credit pricing model. So it's a big thing. It's a new term that we are coming across all the time. But basically that is what it means, that now they will be looking at your performance in the past. Then, so what I need to do, so if you found this, if you find yourself in a position whereby your credit report is not looking good, I have said again, all is not lost. Clean up, work on your credit reports, and make it, make it look good. There's still time to work on your credit report and improve your credit rating with the Credit Reference Bureau. I hope that is helpful, and now you can comfortably be able to understand or explain what we mean by risk-based pricing model for loans. Thank you so much.